Good morning. Thanks for joining me on Saturday. This is actually my second webinar this is going to be an ongoing thing. I'm going to be doing at least 2 webinars a month. So I hope you will join me in all of those going forward. So the theme is always technical analysis based. My analysis on the markets, I do obviously pay attention to the fundamentals. And we had a big announcement from the US on their consumer price index number yesterday, which if I remember correctly came out at 8.6%. Which was above the 8.3% consensus estimate. So inflation higher than expected, inflation continuing to grow. If you've been following me for the last year or so, you'll know that that hasn't come as a big surprise to me. I've been talking about inflation going to significantly high levels for a long period of time. I thought it was fairly obvious, especially when inflation started getting ingrained in the system in wage rises, etc. So I don't think this is the end of it. Maybe inflation won't go significantly higher now because the oil rally seems to hopefully have leveled out perhaps, but I don't see any significant declines in inflation in the near future. Anyway, I'm not an economist, so don't pay too much attention to that, but I am a technical analyst and I've been doing this for 15 years. I've been trading for 34 years, so I have a fair amount of experience and hopefully I can help you benefit from some of that today. Crypto is something that I cover every day for my subscribers, but I didn't cover it in the webinar last week, and I did want to at the end, but I kind of ran out of time. So I'm going to have a quick look at it now. Quite remarkable, really. Bitcoin has been moving very much sideways in a very unusual pattern for Bitcoin, very unusual pattern for crypto, which of course is normally extremely volatile. So maybe this is good for Bitcoin or crypto as an actual real currency where you can actually store value because it's not moving up and down 10% every 5 minutes. But I don't see any particular bullish price action that would suggest that the recovery is on the cards. In fact, quite the opposite. If anything, it looks like Bitcoin eventually will break to the downside. So I do see this as more of a consolidation pattern in a bear trend rather than a base building exercise in before a bull run recovery. So let's see what we've got here on the weekly chart. Clearly, we have been in a bear trend now for a number of months, having not quite a double top there, I guess. I can't really argue that that's a double top. But anyway, we've come down as far as 25,390. The resistance on the first fib level at 31, I'm going to call it 31,700, has certainly been doing a good job. My subscribers have been using that as a sell level and certainly has worked as we keep hitting that resistance and holding. So the fact that that resistance level is holding suggests to me that eventually we will break to the downside. We are a little bit oversold actually on the weekly chart, but I wouldn't pay too much attention to that because markets can stay oversold for quite a significant period of time. Anyway, for now, we're getting some support around 28,800, I should say. So start breaking below 28,600, something like that, could lead to further losses. I'm not going to bother with Ripple because that really is just going sideways. But Ethereum is probably the other one that most people focus on. Now, I actually posted something on Friday morning on Twitter and a few of the social media channels, Instagram, suggesting that this descending triangle in Ethereum would lead to a break lower eventually. Well, I didn't expect it necessarily to come a day after, but it certainly has, or actually the same day. So yesterday we did actually break down in the afternoon. So we broke the previous low, the May low, the early June low. We had the double bottom, a potential double bottom in May. I'm sure a lot of bulls were hoping that that double bottom would hold and the market would rally, and they had good reason to, and I'll show you why in the weekly chart in a minute. But unfortunately, it looks like those hopes are dashed. The fact that we're now breaking below 1,700 can't be a good thing, obviously. When we look at the weekly chart, there is some hope for bulls that they hold this trend line, which goes back to, let me see now, that goes back to September 2021. So what's that, 9 months, something like that? There is a possibility, but the fact that we've broken the previous lows, the fact that that double bottom at the trend line didn't hold, it doesn't bode well for me. And I think that this is probably the beginning of the next leg lower in Ethereum. Ethereum's had a lot of opportunity, had a long time to try to break higher and build a base, but it just does not seem to be happening for those bulls. And I would imagine there's got to be some stop losses somewhere around the mid 1600 area that could trigger further losses. We'll see. Okay, look at gold and oil. Gold has most definitely been trading sideways. That is very, very clear from these two trend lines on the daily chart. And actually, it was quite interesting how on Friday the price action, the low and the high was exactly bang on both of those trend lines. So we've got something of a widening channel here. I don't know what that means for future direction. Probably only means that we're actually going to continue sideways. From a fundamental perspective, I'm quite surprised that gold was so strong on that high inflation number. And you're probably thinking, well, this guy's an idiot because gold always goes up when inflation is high. But that hasn't actually been the case, has it? Gold has actually been trending lower now since March. We've had increasing inflation, and we've actually got a huge double top on the weekly chart, which makes me worry more about the downside than the upside. Here is that double top on the weekly chart. In fact, let's put it on the monthly chart because it's probably a little bit clearer. Don't forget, I do like to check the monthly chart for important levels that we may not be aware of. There you go. There's your very clear double top pattern on the monthly chart. Very clear. When you bear in mind that this is the monthly chart and each candle is only a month, we could have quite a lot of room to the downside to go eventually when the market does crack. Well, it's not cracking at the moment. So let's go back to the weekly chart. We've got a bit of a recovery, but of course the recovery has stalled. Now, if you've been buying gold or holding gold because you think that inflation is going to remain high and you're looking for an inflation hedge, it's not really working for those gold bulls, unfortunately. And as you know, if you've been following me, my view really is that the higher inflation goes, the higher interest rate goes, I think that will send gold down, because why would you hold your money in an asset that is returning nothing when you could put your money into something that is returning something, in bonds or whatever. Anyway, I'm not here to give investment advice particularly, but for the moment, I'm being proved right. Gold really isn't working as an inflation hedge, and it does appear that there is more room to the downside eventually. However, in the very short term, of course, we do have trendline resistance around 1875, 1880. If we were to break above there, I actually see a much stronger resistance level, and we could get there. We could break up. We could get to the sort of 1890, 1900 area. Now, this is a strong resistance level for three reasons. Obviously, we've got this red trend line, which starts right at the top of that peak at 2070. We've got the 38.2% fib, which comes in at 1895, and we've got the 100-day moving average creeping higher at around 1891. So all around sort of 1890, 1900, it's a very strong resistance level, and that might actually be where the big sellers come in, to just test whether gold is actually in a bear trend. So if we break above 1870, 1880, let's call it, we could see a 10-point jump. But more likely, in the short term anyway, could be that we just trade within this range. Obviously, if we do end up breaking below 1820, we're nowhere near there now. So I'll have to review that in the days or weeks ahead. Then that would be more of a significant sell signal. But for now, we've got 1825, should we call it 1820 as support? We've got 1875 up to 1880 as resistance, but the strongest resistance is up at 1990, 1900. So we'll see how those levels work out during the week. Now, this is why I suggest that oil may be at least stabilizing, if not quite ready to turn lower. We've been crawling higher. This has been a very difficult bull trend. If I think I said this to you last week, if I told you down here at $98 that oil is going to rocket up to $123, so what's that? Did I say 98? Okay, so we're talking about $25 rally. If I told you that in the second week of May, that I was absolutely certain that the oil was going to climb $25, and I told you to buy it with a trailing stop, you would have actually struggled to keep that position. We've had such deep pullbacks, such periods of sideways consolidation, a spike up here that didn't last. Maybe bulls would have got nervous on that when we actually closed lower on the day. And 2 days later, we plunged through the trend line. It's been a real struggle, I think, for bulls to maintain a long position in oil. So perhaps we're just starting to run out of steam a little bit. We've been overbought now since mid-May, so we're getting on for a month of being overbought, and maybe we just need a little correction to the downside. If we were to correct, we tried to break this trend line again on Friday, but we just managed to hold it. I don't think I could really argue that this is a double top, so I don't think I could argue that the market is about to collapse, but certainly it does look like oil's running out of steam. So in terms of future inflation, perhaps we could see oil ease back a little bit, which might help inflation in the months ahead. But as I say, I don't actually see a sell signal in oil. That's the problem. Okay, so the higher inflation number on Friday, obviously pushing bond yields higher, pushing expectations of higher rates from the US Federal Reserve higher. And of course, that had an effect on the dollar. But we already had a hint that the dollar was probably going to go higher anyway, because last week I showed you how nicely the dollar was trading. The dollar index was trading within these fib parameters. You know I love my fib levels. And if you didn't watch last week's webinar about fib levels, thanks for the positive feedback, by the way, from you guys who said it was very helpful. You can find it on YouTube. Have a little look at last week's webinar if you want me to go into, if you want to see me go into a little bit of depth about Fibonacci levels and how I break them down. I'm not going to focus on that too much today because obviously I've already done that. But the fact that we broke above the sort of 102.60, 102.80 area on Thursday, surprisingly, I didn't really think that we'd make a big move on Thursday. That indicated to me that the bulls were getting set up for a good recovery, and they were given a nice little push on Friday from that 8.6% inflation rate announcement. So 104.50, 105.00 was my target. We didn't actually quite get there, even up, although we did have a strong run on Friday. We got up to 104.23. We've closed near the high of the day. We've closed very near the high of the week. So that suggests to me bulls are firmly in control, and we can get up and start testing these trend lines at around above 104.50, actually 104.65.70. 105.00, bang on the previous high. So 105.00, of course, is going to be very important. Now, if we get a negative candle on there, let's say we get there by Wednesday, and we get some sort of negative candle, we get a test, we get a spike up to test it, and then the market reverses, we get a red body on the candle, maybe some sort of shooting star, that kind of thing, then that could signal a double top. So we need to keep an eye on that, and I'll try and review that on my YouTube channel during the week. So keep an eye out for any updates. So we are getting to an interesting period, but my guess is actually that the dollar index will break above 105.00. We get a day or two close above there, and that will look like it's the beginning of the next leg higher. And when you bear in mind the inflation situation, that to me looks like the most likely scenario, that this was really just quite a steep bull flag before taking off. It's quite a steep, maybe a bull flag isn't quite correct, but look how beautifully it held the 38.2% fib at 101.23. And then just took off. So really, that was just a normal kind of 38.2% correction in a developing bull trend. And we have been in this bull trend for about a year now. It looks like we could be about to embark on the next leg higher for the dollar. On that subject, let's have a look at some dollar pairs, and the euro would be the first one to look at because I believe that's the most heavily weighted pair in the dollar index. So we should see something of a mirror effect here, and we broke above the 23.6, broke below the 23.6% fib that you see here on the daily chart. Let's just zoom in. Beautifully held that trend line. We didn't quite get to my sell area, which was the 23.6% fib. Can I zoom in on that? No, 23.6% fib at 108.20, sort of 108.20. We didn't quite get there when the index bounced from the 38.2% fib that I just showed you. But we certainly used that as resistance. We certainly used this trend line as resistance. We did try and break above there, interestingly, on Thursday, but we couldn't hold it, and of course we collapsed very significantly. Then this little trend line only goes back a couple of weeks, was broken on Friday with the announcement of the higher inflation rate in the US, and of course the euro has sank against the dollar. So dollar showing good strength, stochastics pointing lower, likely to head into oversold territory, the stochastics, before we can even think about any recovery. Weekly chart looking, well, I'll show you the weekly chart, but there's not much to add really. We're in a bear trend. I don't see anything that can reverse that bear trend. And of course, the fundamentals probably back that up with the fact that the ECB haven't even started raising rates. Yes, they're going to, but they didn't bother on Thursday. So I don't know what they're waiting for, really. It's fairly obvious that they need to get the skates on as far as interest rate rises go, but they're dragging their heels and they're way behind the curve. So for that reason, I would imagine that's another reason why the euro sank against the dollar. And we've now broken lows for the last 2 weeks, of course. The week before, the low was 106.25. The week before that was 105.56, and we're well below previous opens and closes on the weekly chart. All looks pretty negative for the euro versus the US dollar, which backs up my positive view for the dollar versus for the dollar index. Okay, dollar CAD has been a little bit harder to read. In fact, you know, really, what do you do with this? We are just in a sideways trend with very, very wide volatile parameters, but no clear trend to follow. Anyway, I'm only showing you the chart because the dollar has absolutely rocketed against the Canadian dollar, really showing a lot of strength, and there is a good reason for that actually. Now, if you're a subscriber, then you'll already know about this. Oops, I try and yep, here we go. Weekly chart, we had very strong support and a decent buy level, which unfortunately was just missed. But the 500-week moving average, and this is why you've got to look at your longer term charts, even if you're just a day trader or a scalper, you've got to look at your longer term charts, because if you didn't know and you thought, well, the dollar versus the Canadian's in a bear trend, so I'm going to remain short, and you weren't aware that we were just about to test the green 500-week moving average at 124.77. Well, we didn't even get that far. We got to 125.15. Not far. What's that? 40 pips. But that, I would imagine, is the reason why we've reversed so aggressively. We certainly did the last 2 or 3 times that green 500-week moving average was tested. So maybe not a huge surprise that we've seen such a strong positive reaction of it again. Bullish engulfing candle here on the weekly chart. Notice that the low last week and then the higher close above the high for the previous week and above the high. You can't quite see it there, but the blue 100-week moving average, which has acted as a very good resistance level as well, worked here, worked as support on these 2 candles, and then of course we've now pushed and closed above that as well. So that really does look very bullish for the US dollar versus the Canadian dollar. We've got the bounce off the 500-week moving average, we've got the bullish engulfing candle, we've got the close above the 100-week moving average, and less significant but worth noting that we've broken through the 2, the 1 and the 500-day moving averages and the 50 actually on the upside. Now, I'm not taking that too significantly because they're all converging. They are converging and probably will continue to converge because this is such a strong sideways trend, or such a long-term sideways trend, and that's why these moving averages are converging. But still, the fact remains that we've broken up above the short-term fibs and the daily moving averages, which means that this looks pretty positive going forward. I think that's enough for the dollar pairs. The Aussie, the New Zealand and other currencies, of course, they do look weak generally against the US dollar. But the one thing that has changed from that is the yen. Now, the yen seems to be stabilizing against the dollar despite that huge dollar surge on Thursday and Friday. So what does that mean? Does it mean the yen's actually gaining some strength now? Does it mean that the yen may have bottomed out? Does it mean that people are willing to buy into the yen at these lower levels? Let's just have a look at the monthly chart actually to show exactly how low the yen is compared to the US dollar. Now let me just scrunch all this up. Okay, monthly chart. Might even have to go to the yearly chart. Yeah, we almost will. Let's just push it all up. Okay, I'm going to try to get all this on the screen. Here we go. So what you're seeing here, this peak goes back to 2002. We're now getting to 20-year lows for the yen versus the dollar as inflation in the US hits 40-year highs. Is it 40-year highs, or is it even more than that now, I think, after Friday's number? So real significant moves. The question is, are traders, investors, hedge fund managers deciding that the 2002 peak is enough and maybe now is the time to jump into the yen? Well, the daily chart is certainly not giving me a sell signal for the dollar yen, but when you bear in mind how strong the dollar was against other currencies, and yet for the last 3 weeks now on the 3 days now on the daily chart, after a big green candle, we have stalled, and we've got these dragonfly dojis here, as you can see, which sort of indicates some sort of balance at least. Maybe clearly someone is taking profit on a long dollar yen position because it's not managing to push any higher. I don't know what else to say on that. There isn't a sell signal. We've got some dragonfly dojis which indicate maybe some sideways action. The dollar strength against other currencies, I'm sure, will continue, as I've said. We're very overbought, but maybe we're just in for a period of consolidation. I couldn't recommend a short position in this pair, not now without a sell signal. And actually, I need to go back to the monthly chart because I've just missed something that is quite important. I need to tell you. Okay, so I can tell you that maybe I need to take this off. Yeah, I do. Well, I can tell you that there is a longer term 23.6% fib, and that goes back decades. We've broken above that. 130 was a very important area, and the 500-week moving average at 129.40 was a very important area. We broke above that. We used that as support at the beginning of this month, and we have soared from there. The longer term chart says to me that the yen has got further to go on the downside, and the daily chart is not telling me that that is about to reverse. So from that, I conclude that probably we could be entering a consolidation phase for the dollar versus the yen, but as I say, no sell signal. So, and considering we broke above very important resistance levels on the monthly chart, I think eventually further moves to the downside for the yen against the dollar. Now, the Aussie yen has also stalled. The Aussie actually is certainly weaker than the US dollar, of course. The Aussie fell significantly against the US dollar into the end of the week, so it's not surprising to see the Aussie weaker against the yen, which has been stabilizing. However, again, I don't see this as a sell signal. This is not a bearish engulfing candle on the daily chart, although it is a big red candle. And so I think at this stage, I'm going to call it a correction in a bull trend for the Aussie versus the yen. I can't really argue for a double top. It's worth looking at the weekly chart for anyone who wants to argue that this is a double top, because look, we had a negative candle back, where was that? Middle of April. Negative candle, a spike up, a big retracement, and actually a lower close for the week. We've got something similar here this week. The spike up. Okay, we did close higher on the week, but only a very small bodied green candle. So I think that suggests perhaps further correction to the downside. But as I say, I'm not going to take that as a specific sell signal. I think you've got to be quite ballsy if you want to get into a short position. On my strategy, I would rather wait, see if we get sort of down to 92.60, which looks like a good support area for me. Another 200 pips to the downside, but that's certainly possible. And then we'll see if we bounce off there. New Zealand dollar, similar situation. Actually, it looks slightly weaker than New Zealand dollar versus the Japanese yen. We do have a potential double top pattern here. So, here we go. We do have a potential double top pattern, and we do have a long upper wick. Where did we get to? 86.81, 87.34 was the previous high. So we got within 50 pips on the weekly chart of the previous high. I could certainly argue that that is a double top pattern. So how do I put all this together? No sell signal for the dollar yen. Close at the high of the week after a very, very strong week. You'd have to be pretty you'd have to have a lot of guts to try a short position in the dollar yen. The New Zealand dollar yen, as you can see, I could argue that it's a double top. The Aussie yen, there is no double top, and it's probably just a correction in a bull trend. Pound versus the yen, again, could argue that that is a double top. So similar to the New Zealand dollar versus yen, I could argue that this is a double top. Again, look at that, whatever it was, middle of April, spike higher, lower close, small red body. This week, not as negative, but we couldn't maintain the gains, not in the same way that we could with the dollar versus the yen. So there is some yen strength creeping into some of these pairs. I just want you to be aware of that. As, if you think that the yen will appreciate, then it looks like selling against the pound, selling against the New Zealand dollar is the lowest risk strategy, because we do have potential double top patterns in there. Okay, I'm going to finish up with the stock markets. We've looked at crypto, we've looked at the dollar, we've looked at the yen pairs, we've looked at the dollar index. Stock markets obviously affected by higher bond yields in the US, which were triggered by the higher inflation number, and that sent stocks plummeting. They had tried to make a good recovery, and actually I'm quite surprised at how well stocks really have held up when we are clearly facing increasing potential for a recession next year, maybe even the end of this year with this high inflation. It's obvious that the consumer is being impacted very significantly with higher food prices, higher energy prices. In the UK this week, there's a lot of fuss about the cost of filling up your car. £100 to fill up a tank now. The average tank, I think, is it £2 per litre? I don't live in the UK, but I think it's got pretty crazy. So of course, money's been taken out of the pocket of the consumer, which means there's less money to spend elsewhere. I believe that credit card spending has gone up. People are using credit cards now to try to bridge the gap. It's a really, really difficult situation, and there's no end in sight right now, especially with US inflation jumping to 8.6%. UK inflation is even higher than that, if I remember correctly. So, desperate situation. And that's why I'm actually quite surprised at how well things are holding up. Look, the DAX is only something in the region, well, it's less than 3,000 points from the peak. Not much. What's that, 20%? Not really very much when you consider how overinflated stock markets probably got on the back of that whole QE situation. The Nasdaq has obviously been impacted a lot harder because stocks in the Nasdaq were probably bought on leverage, and a lot of the companies, well, it was speculative, wasn't it? Because a lot of them weren't even making any money. Anyway, I'm not going to go into that too much, but I am surprised at how well the stock markets have held up, and it does make me wonder whether people will finally wake up and realize that we probably are headed for quite a significant recession eventually, and stocks need to collapse. What are the charts telling me? This is difficult. This really isn't a pattern that I can decipher. The 100 week moving average, okay, it's acted, I guess, as some sort of resistance level for the DAX. Big red candle. We've closed at the low of the week, so that's certainly probably quite negative for next week. What hopes do the bulls have? Well, there is a trend line that goes back to the low in March. That was that big crash low in March. And I've joined the low in May, which is significantly higher. We're about to retest that. So I guess, trying to decipher it, we really do have to hold around the sort of 13,700, 13,600 area in the DAX. A break below there should lead us down to what is actually good support. This will be more important for the DAX. Let me just squeeze this up so you can see it. We do have, and I'm not going to go back too far, but take my word for it that we do have some good Fibonacci support in the DAX at around the 13,300, 13,100 area, coupled with the 200 week moving average. Again, you've got to look at your weekly charts to know where the moving averages are and the big longer term fibs are. This at 13,200. So it really is important. I'm just looking, yeah, my fib levels here go back to 2018. So 4-year-old fib level there at 13,280. That will be the key support for the week. We haven't closed below that area on a weekly chart yet. So if at the end of next week we collapse, we start closing below sort of 13,100, that's going to be pretty negative going forward. Now the US markets were probably, I was going to say probably more overinflated than the European markets. They were definitely more overinflated. They really had a very, very strong performance into the beginning of this year. But we are well establishing a bear trend for the US stock markets. This little bounce back confused me for a while, and I did think, well, it's quite remarkable strength, and therefore maybe we are going to consolidate and trade sideways. We did for maybe a couple of weeks, and I thought it would last longer, if I'm honest, but it wasn't to be. Thursday we broke down. We broke what should have been a very good support level around 40.50, 40.40. That was a bit of a target for me on the downside, and it was my main support of the week last week, but it didn't hold. We broke through it on Thursday before the inflation number was even released. Makes me wonder if anyone knew about that number before it was released. But anyway, I'm not a conspiracy theorist, so let's just move on. Now, big drops. We've seen a drop from 41.44 down to, well, 3,900. So a huge drop. We're definitely confirming that we are in a bear trend. The 38.2% fib at 41.90, that proved to be the high, followed by a consolidation, then the collapse back down below the 23.6% fib and the 500-day moving average. So this really does look weak. This area down here has been a good support level. And if you remember, for those of you that follow me on YouTube or for those of you that are subscribers, I called the exact low for the correction initially last month. And that was purely because we have the 23.6% fib dating back to 2018 together. Again, another near 4-year fib, and the shorter term fibs from 2020. And this one, where is this one? This goes back to 2020 as well. So beginning of 2020, mid 2020, all of this confluence of Fibonacci support level around the 38.30, 38.10 area did prove to work very well. But we fell at the first hurdle, really, didn't we? 41.86, 41.90 on the weekly chart. You'll remember that we had 41.89 on the daily chart. That was really the first real test of resistance for the bounce, and we failed. So it really to show we are very clearly getting lower highs, lower lows. So therefore, it wouldn't be a huge surprise to see us break below 3,800 this week, close below there at the end of the week, which will then signal a further move to the downside, targeting 35.50 to 3,500. That would another, should we call that another 250 point drop? Certainly a 200 point drop if we break below 3,800. Nasdaq in a steeper bear trend than the S&P, and certainly a lot steeper than the Dow Jones. We'll have a look at that in a minute. We'll finish off with that, in fact. Again, bounce back to the 23.6% fib. Did actually overrun it last week, which gave some bulls hope, but it wasn't to be because we couldn't close the week above there. Again, that's why you've got to look at the weekly chart. Where's the weekly close? The weekly close last week was below the 23.6% fib after we peaked above it during the week. This week, we got as high as 12,800. So as if you're following me or you managed to read some of my free reports, you'll know that 12,700, 12,800 was my strong resistance level for the Nasdaq, mainly based on that 23.6% fib, in fact. So shorts there did well. I don't think I encourage anyone to short them, to run them as far as 11,900, to be fair. I didn't necessarily expect the market to collapse. Of course, I didn't know the inflation number. But anyway, we have collapsed, and we've now broken below this trend line, which goes back to, let me see now, October 2021. We're back below there, so it does all look pretty negative. So the Nasdaq has closed at the low of the day, the low of the week. We've closed above some decent support levels. Looks like we're going to retest 11,500 and a break below there. I don't know why 11,500 was good support on the downside. I think the only reason we bounced off there was because the S&P bounced off its fib support level and it dragged the other stock markets back up. So I don't see that 11,500, 490 area as a good support level. I think it will break eventually, and I think we will go straight to 10,800, 10,700, which actually is a good support level. Again, the only reason I know that is because I've looked at the weekly chart. You wouldn't see that on the daily chart. So you have to look at the weekly chart and see that we have a 61.8% fib dating back to 2020 and the 200 week moving average now at 10,780, but just creeping higher. So anyway, I'm going to take that 10,800, 10,700 area as the next target on the downside if and when we break below 11,490, and we'll see if that support level holds and if that could possibly be the end of the correction. Let's just have a look at the monthly chart and just see if it is feasible that that could be the end of the correction. Okay, I had to just get all my fibs in line. Now this set of fibs here goes back to 2008. Now that was the crash low for the global financial crisis, down at 1,040, would you believe? So the market went up 16 times from 2008 to 2021. Remarkable. What a great ride for the bulls. Now, here, we take that 2008 low, we project that with some Fibonacci levels, and we've got 10,759. That coincides beautifully with my shorter term fibs that I showed you on the daily chart and the weekly chart before I put these on. So 10,000, I'm going to call it 10,800, 10,700 really is an important support level. And I think that will act as a target in the near term over the summer, even if we don't break next week. We've also got the 50-month moving average, the black line, coming in at 10,600. So by the time we get there, maybe that will be sort of 10,650. So that's obviously also adding extra support to that level. It will be very, very crucial. So if you're trading the Nasdaq or you've got some tech stocks, you need to watch that. I think we will be attracted to that level, and we definitely need to hold that. If this is just going to be a significant correction in a bear trend, it would be a significant correction. That would be 6,000 points. What's that in percentage terms anyway? 30% or so, 35% probably, something like that. So that would be a significant correction, but we start breaking below, say, 10,500, and we have a lot further to go. I think we could see, we could certainly see 9,000. Could be another 1,500 point drop, but we'll investigate that in future webinars and on my YouTube channel. Okay, if you've learned one thing from me in the last two webinars, it's that you must look at the longer term chart. And this is actually a yearly chart for the Dow Jones. Now, the Dow Jones has held up quite nicely. When you look at this chart, you see that this year, 2022, we are actually approaching the lows for 2021. So the 2021 low was 29,500. We're a couple of thousand points away from there. That's less than 10%. But that will be a very big support level. On again, taking the low of 2009, the low of the global financial crisis all those years ago. I remember it well. I remember watching the Lehman's episode unfold as I sat in my friend's house in Dubai. I've been around a long time. That was only one of many crashes that I witnessed. Now, look how beautifully these Fibonacci levels tie up, in fact, when you go back that far. You can see that the 23.6% fib at 29,664 ties in nicely with my shorter term fib at 29,671. I've taken the low of that fib at an obvious point. That's the COVID crash low of 18,000. So that was an obvious place to put my second set of fibs, and how beautifully it tied in actually with what has now become the 61.8% fib at 18,000. Don't you think this happens all the time? There is something mathematical about financial markets. I don't fully understand it. I've never really investigated it, but this happens all the time. We did not know in 2020 that we were going to go to 36,832. I didn't know that, but we got there, and that was it. That was the peak, and it just so happens that when we then project our Fibonacci levels from the 2009 crash, global financial crisis crash low, we find that the 23.6% fib just happens to be almost exactly at last year's low. The 61.8% fib just happens to be exactly at the COVID crash low. Isn't that remarkable? Anyway, so it just gives me extra confidence that these fib levels are very important, because they do coincide with incredibly important swing high and swing lows. So for me, on the Dow Jones, if you're trading the Dow Jones, see how these levels tie up with the S&P and the Nasdaq that I've given you. The 29,700 down to 29,600 is definitely going to be an important level if we see further losses in the Dow Jones, which it looks like we probably will. Today, this year's crash low is, this year's low is at 30,585. So a break below 30,500, if it happens this month, should see us down to 27,700 to 27,600. Right, I'm going to put this back on the weekly chart, and I'm going to call it a day. How long is that? 36 minutes. You've probably had enough of me talking now. I hope that gives you some insight into my technical analysis techniques. I really keep it very simple. I use trend lines, I use moving averages, I use Fibonacci levels, I use candlestick patterns, I use candlestick formations, and then I look at 4 different time frames, 5 different time frames sometimes. That's pretty much it. I do have a course on my website. Let's just have a look at that. Okay, if you like what I do and you want some more information, my website is daytradeideas.co.uk. Click on the menu, and we've got a blog there. My training course is here. I did have an offer on that last week. It's £399, and a few of you signed up for that, so thanks for that. I've got some good feedback already, and you've said you found it useful. If you're interested in that and you want to get last week's deal, I tell you what, contact me through my website. Go to the contact us page. Say, hey, I missed your offer last week, but I really want to get involved. I offered 80% off. The course only £79. It's a bargain. I haven't repeated that offer this week, but you know what? Out of the kindness of my heart, I'm going to give that offer to you again. But you'll just need to contact me through the contact us page on my website. I'm actually starting to offer free 15-minute mentor sessions with me. So if there's something that you're struggling with your technical analysis or with your trading, you don't have to be a subscriber. Go to the website, click on the free 15-minute mentor session with me. We'll book a Zoom meeting, and I'll see if I can help you. And if you haven't contacted me before, I'd love to hear from you. It's always good to hear from new people and hear how I can help them. The other thing that is worth looking at is my blog. Please have a look. I post loads of educational stuff on there. I also post some analysis on there. It really is worth it. And you can actually sign up for blog updates so you never miss an update. But visit here regularly. I've got my rules of trading, the sins of trading, how I use a stochastic oscillator, how to trade support and resistance, the Pareto principle. That's something you should know if you're a trader. I had information about that was the webinar from last week. 18 reasons why you must use stop loss orders. And if you're new to trading, I've even got an introduction to Forex trading, which you should find very useful, just about how you read the spreads, that kind of thing. Of course, if you want me to help you improve your trading, and you want my trade ideas every day, you've seen how my analysis works. If you want my trade ideas every day for you short-term traders, then go to Daily Technical Analysis on the menu. It'll bring you to this page, and there you can look at what offerings we have, as little as £50 a month if you're trading for just single market reports. If you want the whole package, access to me, a daily cheat sheet that you may have seen posted on Instagram or Twitter, then you want to get yourself a gold membership or a premium membership. But again, if you've got any questions of that, just contact me through the website. I have a special offer which should be coming to you, which is if you want any of these packages, or you want the premium package, but you don't want to pay for it, you don't want to pay £199 a month, I've actually got a solution for you. You open up a trading account with our preferred broker, deposit a minimum of $5,000, not a huge sum of money, trade my levels. I get a small commission from the broker every time you trade, which hopefully will add up enough to cover your subscription, which means you get my service for free, I still get paid, and everybody's happy. And I can really help you build your trading account. If you do that, you've got me on tap, kind of thing. You've got me whenever you need me. You can WhatsApp me with your questions, hey, what should I do with this position? Should I be getting into this trade? I'll be there to help you. So it's remarkable. You get all of that for free. All you've got to do is open a trading account. So you should get an email with that offer. Click the link, open the account. If you get stuck, again, contact us. And on that page, actually, you've got my WhatsApp number, you've got my Skype, you've got my email. There's a form to fill in. So it's very easy to get hold of me. There's the contact us page. There's my WhatsApp number, email, Skype, everything else, or just fill in the form. Okay, I hope I've helped you. Really welcome your feedback. Email me back with any questions and anything I can do to help you, and any feedback or suggestions for future webinars would be very welcome.